So we've covered a lot of opportunity zones in our group over the years. We've probably been going back about 3 or 4 years, particularly in California, and then some in New York and Texas, et cetera. There's been a lot of great growth and opportunity zones near university environments, I think in many states. But we've got a poll that's running. And so what I want to do is Michael Berwick's going to be leading this discussion. And Kent Fitzpatrick, who actually runs Asset Strategy Advisors, is going to be speaking. So I was hoping that Ken can get some discussion about Asset Strategy Advisors before we get into this. And then once everybody's introduced themselves, I'll end the poll, release it to the speakers, and we'll go from there. So Michael?
Great, thanks, Marty. I got to tell you, the last panel was a tough act to follow. I got a lot out of it. I enjoyed it, although Eric, you scared me a little bit at the end when you started in the same sentence to talk about dogs and the Korean market. I had to pause for a moment. Sorry, I'm a dog lover. It was a joke. One of the things that I mentioned in my sort of intro to all things asset strategy this morning, that first and foremost, and again, Kent will articulate this better than I, asset strategy and the family of companies underneath the asset strategy banner are really the bedrock. There is fee for service, fiduciary, wealth management and so forth. But as I said earlier, we do dive into the transactional side of the business in a very limited sense. And with that, I can tell you that as an independent big law firm, a lot of my clients are in the space, are in the financial services space, whether they're funds, whether they're registered as investment advisors, or whether they are in fact brokers and dealers. And with that, and the tax element of sort of where my expertise is, I've looked at a lot of entities that are in this space of deferred capital gains taxes, and that really takes the form of both Delaware Statutory trusts as well as qualified opportunity funds, qualified opportunity zones. And there's just nobody out there, with all due respect to my other clients, that is as deep and as selective in their process as asset strategy. So we're going to do some quick introductions. We'll get into some basics of the 1031 rules. We'll talk about Delaware Statutory trusts and the fact that they are the mechanism at this point, the main mechanism by which passive 1031 offerings get to the marketplace. And then we'll get into some opportunity zone discussion and some Q&A. So with that, let me pause. Thanks, Sean. First I'll introduce, I guess, both Kent and Sean, if we could do the next slide. And Kent, if you want to go back and talk about asset strategy, which I realized was the preceding slide, that's fine. I'd like to just introduce Kent Fitzpatrick and Sean Whalen. They are my colleagues, and Kent manages the firm. Sean really directs our private wealth division. And I guess with that, to talk about asset strategy and a little bit about their own backgrounds. First, I see that Kent and Sean are on the same. So you're looking at Kent right there, but that's Sean's. So I'll go to you, Kent, who's apparently playing the role of Sean Whalen.
Great. Well, thank you, Michael.
Sure.
Glad to be participating this today. And so far, all the speakers have been fantastic. I do want to put maybe a shameless plug, because I think it's additive to this topic we're going to be talking about, and that's if you guys Google Michael Berwick and Bloomberg, you'll see an article that he just published about 2 weeks ago, which was basically on the evolving landscape of capital gains taxes under the Biden-Harris administration. And I think we're going to be talking about a couple of those topics today. And we've spoken to attorney groups, CPA group, realtor groups, investor groups, about some of these areas, and everyone we've spoken to have said, "Gee, I'm very familiar with 1031," and I said, "Well, you should be. It's been on the tax code since 1921." But they're not as familiar with Delaware statutory trusts or even opportunity zones. And I know you've had other speakers speaking about opportunity zones, but I think what we're going to do is start with the basics of 1031 just as a primer. We'll pivot to Sean to talk about Delaware statutory trust and some planning techniques with that, and then some back and forth with opportunity funds because they're not mutually exclusive. And I always like to start this segment with a quote. And before I do, Mike had shared with you our practice is really in two sides. You'll hear from our practice leader, John Gentry, later in this afternoon's session, talking about retirement considerations, retirement planning. So we are fiduciary consultants in that space. And then, as Michael mentioned, our private wealth side, which is headed up by Sean, really we have a sub-focus in tax advantage wealth strategies. So even in that article that I referenced at the beginning, Mike talks about things like 453 installment sales or 121 exemptions for personal residents or opportunity funds or Delaware statutory trusts. So it's really the tools that we have or the arrows in our quiver to minimize taxes. And the quote I'm going to share with you is from Supreme Justice Learned Hand, and you'll see that it's not patriotic to pay more taxes than necessary. And so the quote goes like this: "Anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the treasury. There is not even a patriotic duty to increase one's taxes. Over and over again, the courts have said that there is nothing sinister in so arranging as to keep taxes as low as possible. Everyone does it, rich and poor alike, and all do right, for no one owes any public duty to pay more than the law demands." So I thought that would just be a good place to start. So this is not tax avoidance; it's maximizing what tools are available to you. So let's jump into some of the basics of 1031. And one of the things I want to reference is the Tax Cuts and Jobs Act of 2017, which went into law on January 1st of 18, 2 years ago. Did two things. Number one, it eliminated the possibility to exchange personal property and only allows for real property, or think of it as real estate, which would include raw land, for purposes of exchange. So you can no longer defer personal property. But what the law also did is that's what created the opportunity zone regulations, which we'll touch on in a little bit. So basically, you're deferring taxes. And ultimately, real estate is one of the unique assets where you get a full step up in basis at death. So you hear the expression "swap till you drop." So 1031 is really only for use of real property. Now, what are those taxes that we potentially would be paying if we didn't do a deferral? Well, at the federal capital gains rate, I can tell you that for the most part, unless someone is in a lower income tax bracket or the asset they're selling is more modest, it's pretty standard. That's a 20% federal capital gain. We've included the tables for the 2021 hurdles. And so that income includes the actual asset you've sold as well. So if someone has a more modest income, the sale of an appreciated asset with capital gains easily puts you in a 20% tax. People are also familiar with the state tax level. I'll share a table with you in just a moment. But I think the two gotchas that slip through are the net investment income tax, which is 3.8%, and the 25% depreciation recapture. Now, keep in mind, if I own a residential income property, the depreciation is 27 and a half years. And a simple rule of thumb is approximately 4% depreciation per year. If I own anything outside of personal residential real estate, such as an industrial center, or retail, or even office, then the life expectancy depreciation is 39 years, or just shy of 3%. So it's easy to kind of do the back of the napkin. And what I always recommend people to do is familiarize yourself with your Schedule E, because the Schedule E, at least on your 1040, will give you your gross income, 15 lines of expenses plus depreciation. And really it's that 25%. If I've owned an asset for more than the 27 years, I fully depreciated the asset. I have no offset to my income. then that's pretty tax inefficient. So keep in mind the type of asset you own. This table, it's a national table. I know this is a national call, is from the taxfoundation.org. So each state will have its own tax rate, and including some of the tax exempt states. So why would someone be motivated to do an exchange? Well, I think there's a number of reasons. I just gave you one, where depreciation. So if I fully depreciated an asset and I want to exchange it into another asset, and let's say maybe I put leverage or debt on the new asset, I can reset the depreciation to offset some of that income. Certainly looking at cash flows, I know here in the greater Boston area, values of properties, especially multifamilies, have escalated exponentially. But I know, being a landlord myself, sometimes as a landlord, you want to keep good tenants. You don't want to disrupt anything, so you don't keep your rates on pace. So your return on your investment isn't as great as maybe it could be. And I always say to people, well, is this a hobby or is this actually an investment? Because I think you really need to separate the two. So this is another way of looking at or examining your cash flow depreciation. The other thing I would add to this list is actually diversification. So if I own several multifamilies in a given market, such as Chicago, Boston, New York, wherever you may be, maybe the cap rates are at all-time lows, and maybe the market's at all-time highs. And it may be good to diversify, not only in terms of location, but also gives you the ability to consider exchanging into other asset classes. So right now, I would say office space is probably at an all-time low. There may be some opportunities to buy at a low or exchange at a low, but diversifying my portfolio. So maybe I want to get an Amazon industrial center, or I want student housing or senior housing. This is another motivation for the 1031 exchange. And the other thing I would also add too is we've had situations where real estate was part of a sale of a business. So we've had folks that have had, let's say, a dental practice where they own the building, they had the practice. As I said before, goodwill and personal property are not exchangeable. Maybe those capital gains exposures could be addressed through an opportunity zone, which we'll talk about. But the real estate portion of that can be carved out. So something to think about as well. So think about real estate when you think about 1031.
And sometimes we get a common question about 1031s and vacation property. Can you address that for the audience?
Yeah, great question. So again, you have to exchange like property. So it can't be for personal use. So the rules basically say that you can use it, a property personally, for the greater of 14 days or 10% of the amount of time it's rented. So let's use that example. If I bought a property on Cape Cod and I rent it for 10 months out of the year, or let's call it 300 days, then I would be able to personally use that asset for up to 30 days or 10% of the time. Now, if I'm down doing repairs to that asset, that's not counted in the 14 days, but you have to be careful on that. And I think what we've seen folks do is, let's say that they own a 3-family and they ultimately want to retire in Florida or in the Sand States. Maybe in advance of that retirement, they buy an asset through an exchange, rent the asset, and then after typically the look back is 2 years, convert that asset to personal use, and that way they can still enjoy the benefits of a 1031. So in regards to vacation property, you got to just be careful about how much personal use you're planning on enjoying, or you're setting yourself up to maybe have it as an investment property initially, and then make that conversion. So again, another confusion I find is that someone says, well, gee, I got a 3-family and I got to, if I want to sell it, I've got to buy another multifamily. Well, that's not true. You can exchange, raw land that you're holding for investment purposes to any other type of asset class. And I think that's a good way of diversifying as well. One important thing is that if I'm contemplating doing a 1031, it's imperative that you engage a qualified intermediary, or I'll refer to it as a QI, before the process. We've had a number of people that have contacted us after the close of the sale and said, hey, I want to do one of these 1031 programs or Delaware Statutory Trust, and we unfortunately have to tell them that it's too late. So you have to have a disinterested party, a qualified intermediary that takes constructive receipt at that closing, holds those assets, and we'll talk about what the timelines are in just a moment to satisfy the completion of the exchange. And it can't be, as this slide shares, your personal attorney or CPA. It has to be a neutral, disinterested party. There are a number of excellent firms that are national in scope that we could refer you to. So the basic rules are equal to or greater. So if I have debt on a property and I have equity, I need to exchange debt for debt and equity for equity. And if you do what's called a partial 1031, or let's say I downsize, I sell a property for $2 million with $500,000 worth of debt, and I want to buy a smaller property for $1 million. Well, I could do that. I got to replace equity for equity, debt for debt. But what you're doing is you're creating what's called boot. So you will pay tax on the differentiation between what you sold for and you didn't exchange for equal or greater amounts. That's another great area that when Sean talks about Delaware Statutory Trust, you can use that as a mechanism to soak up that boot, so you're not paying taxes on that differentiation. Here's just a simple example. So an asset that's being sold for $750 has $200,000 of debt, $550 of equity. In this example, buying a replacement property for $825, I'm financing $275, so equal to or greater than on the debt side, and I'm exchanging my equity in equal amounts, $550. So in this case, there is no tax or boot due in those 4 flavors of tax we talked about at the beginning. So these are the timelines or the basic rules. So from the moment that I close and those funds are received by the qualified intermediary at the closing, I have 45 days to identify, and there are no extensions. And even through COVID, there was no extension to this rule. And it doesn't matter if it's a Sunday or my dog ate my homework. 45-day rule to identify, and then you have an additional 135 days or 180 in total to close on that new property. So these are the rules for the exchange. So it's either the 3-property rule, the 200% rule, or the 95% rule, which we don't see, and I'll explain the third one in just a moment. But typically, if I'm selling an asset, I can identify up to 3 properties of any value within that 45-day time period to be potential candidates for exchange. And then again, I have an additional 135 to close on one of those properties. If I want to identify more than 3 properties, then I'm subject to the second rule, which is the 200% rule, which basically says, listen, if I sell an asset for $1 million, I can identify as many properties as I want, as long as it doesn't exceed 200%, or in that example, 2 million for that exchange. The third one, which we don't really see used that often, basically says you can identify as much as you want without any 200% cap, but you must close on 95% of the assets that you identified. So that kind of paints you into a corner a little bit. So it's a little bit harder to satisfy. So we typically see the first 2 rules in the exchange.
Kent, I think that 95% rule was put in by the Congress back in the day to basically disincline exchangers from identifying an unlimited number of properties and thereby sort of defeating the identification rule. And they basically said, if you're going to go with more than 200%, you're going to have to buy, most of them, 95%.
Yeah, exactly. And there's been a lot of discussion too about with the new Biden administration, there's been some talk about, 1031 coming under attack or elimination or whatnot, but we don't see this being an immediate issue. I think because of the timing of some of the, Senate races that are coming up, but it certainly is an issue. And I know that, the Trump administration, obviously a very real estate friendly president, has used the 1031 himself. So I don't know how much of that was in spite to get at his the president at the time with the discussion, or if there's merit to the elimination or modification of 1031. As I said before, it has stood the test of time since 1921. But I would say that anyone on this call that either owns investment property or would contemplate owning investment property, maybe using one of those techniques I talked about with a vacation property, you need to keep your ear to this and make sure this doesn't go through, because this would be devastating, I think, to the economy if it would really have a negative effect on all commercial real estate transactions. But with that, I'm going to turn it over. So Sean is going to talk to you a little bit about some active versus passive strategies using 1031 exchanges.
Thank you, Kent. Good morning, everybody. Thank you for joining us today. Really appreciate it. So like Kent said, 1031 is a very powerful tool. There's not a lot of tools that the IRS allows us to use. So, when it comes to real estate, we really, educate our clients on the power of 1031 exchanges. And the next slide and this part of the presentation will discuss kind of a couple different paths investment property owners can go down once they decide and make that decision that they're going to sell that investment property. So this little decision tree that we created, as you can see, basically shows you two paths when the investment property owner decides to sell. They can either just straight sell, pay the taxes, like Kent mentioned. There's federal gains up to 20%, state capital gains with California getting up to around 13.3%, appreciation recapture 25%, and the net investment income tax of 3.8%. So it can really add up really quickly. So once a client becomes comfortable with the 1031 exchange process and the benefits to it, the deferral benefits, there's two more paths they can go down. They can either continue being an active landlord, or they can now become a passive landlord. And what we're going to discuss now is Delaware Statutory Trust. It's a way back in 2000, Delaware Statutory Trust is just an ownership structure. It's been around since the 80s, but the IRS approved DSTs as a structure in a 1031 back in 2004 with a revenue rule in 2004-86. So that being said, Delaware Statutory Trust allows an investor to purchase a fractional interest in a high quality property or portfolio property. So like Kent mentioned, if you own a two-family or duplex, you don't necessarily have to exchange into a two-family or duplex. You can exchange into an industrial, you can exchange into a self-storage, you can exchange into a variety of different assets. Same thing with raw land. A lot of clients have raw land just sitting there, and they're able to exchange that portion and get it into a more income producing type property. So these are some of the examples of DSTs: multifamily housing, healthcare, self-storage, retail, student housing, industrial, and office, just to name a few of them. You have to, and I know most folks on this call are accredited or speak with accredited investors, but we just want to make sure most of these investments are Reg D investments, as opportunity zone funds as well. So your clients have to have a net worth of $1 million or above, not including their primary residence, or have to have an income of 200 or more each of the last 2 years, or 300 or more with a joint couple in the last 2 years. So just like Kent mentioned, potential benefits of the 1031. I just want to make sure you guys understood, you guys and gals understood the potential benefits of a DST. So obviously the tax deferral, we're able to use the DST in a 1031 exchange. So you still get that same tax deferral as if you were buying a physical property in town or across the street. Tax forgiveness, it's the same premise. You would continue to do a 1031 exchange until death of the owner, and then the heirs would get the step up in basis and then ultimately have a tax forgiveness at that point. Another advantage, benefit of DSTs is, these are institutional properties, 400 unit type multifamily units in Dallas, Texas, or, Orlando, Florida, wherever the case may be. So it's a high quality investment, asset class versus just the two-family or three-family across the street in your local town. Diversification to help reduce risk. So you can, with minimums as little as 100,000, you're able to diversify a portfolio of 500,000 with 5 different DSTs. You can have some in multifamily, some in self-storage, industrial, whatever the case may be. So that really helps give you a broader diversification in your investment portfolio than just the typical, physical property across the street. Liability protection, debt replacement, there's non-recourse debt. So a lot of people, you don't have to go out to the bank and get financing. A lot of the DSTs are built with a loan to value between 45 to 55%. Potential for monthly income. Monthly income usually starts between 4.5 to 6.5, depending on the asset class. Most of it's paid out monthly. So it's a great source for our clients because a lot of our clients have owned their properties forever. They have a strong tax, liability. So they really want to defer the taxes. They want to take advantage of the hot real estate market, but not be a landlord anymore. So this is a really great tool for them and a great planning tool for their family to kind of take advantage, but diversify, buy in other parts of the country and really diversify their portfolio and defer those taxes. So as most of you know, I'm sure most of you are familiar with the 1031 exchange. I heard some earlier panelists mention it as well. Basically, just a quick little example, no exchange versus one with somebody doing a 1031 exchange. You can see the impact of how the taxes will eat away. 6.1 is just kind of a national average of state tax. So you get it down to almost $700,000. That's a $300,000 loss just straight to taxes. So when our investors invest, they would invest that $1 million. They would start getting their interest, their income based on that number. So, when you're at a 5% or higher range, the difference can really, really add up. So, and I mentioned all the pros, but just so you know how DSTs work, they're usually, they're 4 to 7 years typically in length. They're illiquid. There's no secondary market. So it's just like real estate that you would own the real estate until maturity. The sponsor is control. So they're the ones that are figuring it out when is a good time to sell. So it's a really unique and a really great planning tool that a lot of our clients have used over the years and really helped open up their lives so they're not a landlord till death. And so
Sean,
really
could you talk about maybe what happens at the end? You mentioned the 4 to 7 year holding period.
Sure.
What happens at the end of a cycle?
Sure. So typical, one of the rules that the DST, that the IRS put in context for the DSTs was they can't go longer than their financing. So most sponsors will use a 10-year, debt instrument to finance the property. So they can't go longer than 10 years. And then the sponsor themselves will try to get out in that 4 to 7 window, maybe a little less, maybe a little longer, whatever the case may be. But what happens at the end, you'll get a 30, 60-day notice saying, hey, we have a buyer for our property. We're going to take it. You're going to have to find a home for your proceeds. So at that point, you're able to continue on and you would have to get a QI again, do another 1031 exchange. You can exchange it back into another DST. We would have to just find whatever is available at that time and what we thought was most appropriate. Or you could exchange it into a physical property. If somebody said, hey, I miss being an active landlord. I really want to do it again. You can certainly do that. And then the third thing is they could just say, you know what, I just want to get out. I just want to pay the taxes and then get out. So you have flexibility after the initial investment, but just during the investment, it is illiquid and it would be held for, at least 4 to 7 years in most cases. Thanks, Mike. So now to opportunity zones and qualified opportunity zone funds. I'm just going to give a little high level of the origination, and Kent will kind of close it out. But basically, the idea of opportunity zones was created by Sean Parker. He was the founder of Napster and the first president of Facebook. So he knew there had to be a better way. He had all these built up capital gains from his Facebook days. And instead of just writing a check to the government after selling it, he really wanted to have some impact investing. So he created a foundation and he started working with Republican Tim Scott out of South Carolina, as well as Democrat Cory Booker out of New Jersey on the opportunity zone structure. So basically it connects people with capital, and those are the folks, the investors with capital gains, to areas of the country that are just desperate for capital that really need an injection of new life. And those are called the opportunity zones. There's over 8,700 opportunity zones throughout the country. And as you can see, this is basically the mantra. Opportunity zone investments were created to help drive real estate development, job creation, and overall economic growth, which can then have a compounding effect on the original investment, potentially benefiting investors and communities alike. And as Cory Booker said a couple of years ago, opportunity zones are domestic emerging markets, which I thought was a really, really powerful quote. And as you can see as well, there's $6 trillion as a few years ago of unrealized capital gains. So, a lot of people just sit on it because they know the tax consequences. So this was a way to try to, pull those gains out and also help some of the other parts of the country. So, like I said, 8,700 plus of opportunity zones throughout the country. You can go to the eig.gov.org, website to find a map, an interactive map where you can put some addresses in and can really see if your areas are in a opportunity zone. But basically, the governors of each state were assigned to create this. It's based off of the census information from way back to 2010. So the data itself was a little outdated because it was based on 2010 census, but the purpose was in a right direction. So with that being said, I'll pass it over to Kent, and he can kind of finish off the opportunity zone presentation.
Fine. How about one more question before Ken comes in? If I own property in an opportunity zone, can I create the same tax benefits as a fund?
Yeah, do you want to take that since
Sure, yeah.
Oh, what a perfect segue.
Yeah,
that's great.
and we only have a few minutes to wrap up here, and I wanted to try to leave some time for comment. But so your question is, no, owning property in an O-zone, and I would recommend the reference is eig.org is a website that actually has an interactive map. You can put an address. So you only get the benefits of investing your gains in a qualified opportunity fund, and the fund itself is reinvesting those assets either in businesses or property in those zones. So you may have seen a nominal bump up in the valuation of your property because it happens to be in an O-zone, but you get none of the tax benefits for investing in an opportunity zone unless you're investing in a fund, which is a mechanism to invest in that. And then just very briefly, just a couple of the basics. I know we're running out of time here. Really, it's three things: defer, reduce, and eliminate. So you're deferring your capital gain for till the end of 2026. So you're basically deferring for 5 years. You're paying your tax, let's call it in April of 2027. So you had the benefit of those taxes that would have otherwise been paid to the feds or the state, depending upon if you're a complying state or not. In your portfolio, in your account, you will pay the tax in after the end of 2026, but you'll get a 10% reduction if you hold on to those assets for 5 years. And something to keep in mind, this is the last year, unless there's an extension of the O-zones, that you're going to be eligible to hold the assets, those gains in a fund to meet the qualification through the end of 2026. So we'll see what happens. And then any future growth is also growing tax-free. So let's use a very quick example. I have a low basis in Apple stock or Bitcoin. And let's say I have a $100,000 basis and I sell my Apple stock for $1.1 million. I have a $1 million capital gain, which I would normally pay my 20% federal capital gains in any state. So I can defer that paying any taxes for the next 5 years. If I take all of that gain, I can take my basis off the table, my 100 grand in my example, and reinvest all or portion of that gain. And as long as I'm meeting the 5-year hold, I will get a 10% reduction. I will pay my tax. And then if I hold for a full 10 years, I'll pay no future gains on that opportunity fund investment. And just in the interest of time, I've got to skip down to a slide because I think it's quite important. And I actually made a little bit of a mistake when I said that 1031 didn't enjoy any benefits, and that was of the pandemic extensions. There was a brief window. It was a timing issue if your 45-day identification was between February and May of last year, but since that's water under the bridge. But opportunity funds, two very important distinctions here. On the top left, if you're an individual, you can actually go back to any gains recognized from October 4th of 19 and still have the benefit of reinvesting that. Now, obviously, if you filed your 19 taxes, you'd have to refile it, but it would give you an opportunity to take those gains and reinvest it in an opportunity fund. If I'm part of a pass-through entity, such as an LLC or partnership, I can actually go back to the beginning of 2019. So I really have over 2 years worth of tax re-strategizing to deploy opportunity fund strategy. So, Michael, with that, I'm sensitive that we're up against the clock here, and if Marty gives us the hook, or Sean wanted to add a last comment.
Hey, Mike, just before we pass it back to you, I just want to add one thing. With the difference between 1031s and opportunity zones, we usually lead with 1031 exchanges and DSTs when it comes to real estate investment property owners looking to sell, as long as we get the QI involved before the sale and all that. But then on opportunity zones, it's for anybody that sold stock, sold a business, sold real estate, sold Bitcoin. There's a lot of different other capital gains that planning that we do with opportunity zones, depending on the asset and depending on the time. So I just want to make.
Or Sean, I thought your best example was actually the sale of a business that has both a real estate component and a goodwill component, in terms of these two strategies don't need to be mutually exclusive. They can be used in conjunction with each other.
Correct. Yeah, and the last thing I would just say before Marty gives us the hook here is we do have a table, if anyone is interested in it, that we can share or distribute, kind of comparing and contrasting 1031 versus opportunity funds that we'd be happy to make available.
And I know, Marty, if you want to pose this, or I will, there were some questions regarding the future of the Opportunity Zone, Opportunity Fund, technically Jobs Act legislation for the new administration. And again, if you want to deal with that, that's fine. Otherwise.
Yeah, I mean, feel free to answer any of the questions via chat that the audience may have for you guys. But I did want to ask one question of Mike Berwick, just sheer conjecture. You know, in 2008, 2009, there's a big real estate crash, and obviously the U.S. printed $7 trillion of money. A lot of it went to Europe. So all this money went out to keep, global trade going. And then it found its way back when there was, I guess, a waiver of the foreign money laundering for buying individual homes. Do you think that there's going to be a reenactment of something like that?
I think the dynamics this time are really different. I think that to the extent that real estate needs to be shored up domestically, at some point, the payment of mortgages and the moratorium, I think, was the word that my plus 50 mind was grasping at there for a moment. But this moratorium on the payment of rents, mortgages, et cetera, is going to need to be dealt with. And I think that's going to hit certain asset classes harder than others. And that's one of the things that we're very sensitive to here. And one of the reasons why we look very carefully at assets like Amazon fulfillment centers and, other types of assets that are conducive to these types of transactions that are actually growing and that are acting inversely proportional to where the stress on the real estate marketplace is likely to be felt. And again, I think Kent and Sean, leading this effort on our behalf have just done yeoman's work in terms of being able to think ahead, to think forward, and to contemplate where we are, where we're going, and to advise our clients appropriately.
Great. Well, fantastic information. And we always enjoy talking about opportunity zones. So